Okay, so guys, we're going to start with the next accounting standard. And the best part of this standard is you have a 5-mark question from this topic, accounting standard 13 on accounting for investment. And also you have a chapter on investment accounts, that is chapter 9 in your study material. That will come for another 10 marks. So there is a chance of you getting 10 marks is always a question. From chapter number 9, there is always a question on investment accounts for 10 marks. That is for sure. Plus, you might get another 5 marks over here. Or maybe that will be 5 marks and this will be another 5 marks. That is a possibility. But generally, they ask a 10-mark question from chapter 9. And also a 5-mark from this topic, accounting standard 13. That is one chapter. You have to know accounting standard 13 to tackle the examples of questions in chapter 9 in your study. What I will do is, I'll complete AS 13. I'll do AS 13 for you. And also take up chapter 9. Okay. And there's one more standard like that, accounting standard 3 on cash flow statement. And also you have a chapter on preparation of cash flow statement. Is there in module 2? Now, without further delay, let me start with accounting for investments. Please make a note in your notebook. Please write AS 13. I'll write the heading as accounting standard number 13. And please write the title of the standard, accounting for investments. Now let us understand the definition of what exactly is an investment. And this standard for accounting purpose, they say that classify the investments into current investments and long-term investments for accounting purpose. Now let us first of all understand the definition of investment. Refer to para 3. Refer to paragraph number 3 in your accounting pronouncement book. In that, refer to para 3, 3.1. Defines what is an investment. And also we'll read the definition, what is the meaning of current and long-term investments. And then you can take down these 3 definitions in your notebook. Is that fine? So let's go through the definitions. Yes, sir. It is a 3.1.
Next page. Yes, sir. 3.1. Investments are assets held by an enterprise for earning income by way of dividends, interest, and rentals for capital appreciation or for other benefits to the investing enterprise. Assets held as stock in trade are not investments.
No. They say that investments are assets, and you all know that. So they say very clearly investments are assets. You know, why do you call something as an asset? Because that is going to generate
Income.
future economic benefits. And those FEBs or future economic benefits can be either the asset generating income. Example, suppose you buy shares in a company, what do you get? Dividends. Suppose you buy debentures, what do you get? Or government bonds, you earn interest. That is, suppose you deposit money in a bank, also you earn interest income. Suppose you purchase a property, land and building, what do you earn? Rent. It is given that investments are assets that generate a future economic benefits in the form of income, nothing but dividends, interest, or rent. And there is one more FEB from an asset. What is that? The asset price will increase. That is why you have a chapter in tax also, capital gains. You buy a property for rupees 1 crore, and now the property is worth rupees 5 crore. And 4 crore is a capital appreciation. You get it? So that is the beauty of an asset. It is not just generating income. Also, the price of the asset increases. That means I'll be holding the asset for capital appreciation. For example, you buy some shares in a company at rupees 100. You earn dividends on those shares. And also the share price from 100 can go up to rupees 300. What is the capital gain? 200. That's what they say, the economic, they don't say FEB, but that's what they meant. Income, that is either dividends, interest or rent, or for capital appreciation, that is increase in the price of those investments, the shares, the debentures or property price increasing. And they also say there can be other benefits that will flow to your enterprise. Means the holder of these investments. If you are the holder, you are that enterprise. You are that entity. You are the holder of that investment. What are other benefits? Other benefits can be, example, you buy shares in a company that produces some raw material needed for your product. By purchasing shares in that other company, there is a constant and a continuous source of supply for my company. Yes or no? I get raw material. You will get it. So what happens is sometimes you acquire another entity for other benefits, just not for dividends. That's too narrow. Not for increase in share price. I can get other benefits from that entity. Example, Walmart purchasing Flipkart. So they can market their products through Flipkart. You all get it? And that is the advantage of holding such investments. That is other benefits that accrue to the enterprise holding those investments. Example, me purchasing a school having +1, +2 commerce. What is the advantage? I get a supply of CA foundation students. Yes or no? Think about it. So that is the reason you do something called a backward integration. You go purchase a supplier entity. The person who to supply material to you. That is why you'll find a lot of companies investing in, example, Walmart purchasing Flipkart, or maybe a company like Hershey's, they could go and buy a farm, a cocoa farm in West Africa. The reason for they get a constant supply of the cocoa bean, which is required for making the chocolates. Very simple. It is too narrow to think only I buy shares only for dividends, interest, and I buy some property only for rental income. I can buy shares in other entity because I want to enjoy other benefits, other perks or perquisites. So that is when you call something as an investment. Say investments are assets, they're very clear. And these are assets because they're going to generate some future economic benefits. Either income or capital appreciation, or there can be even cost savings for me. Because if I want to purchase material from outside, I have to pay rupees 100 per unit of cocoa. Whereas I can get from another farm or from another entity, which is, that is my subsidiary now. I can get at a lower price. When my price of input is lower, what happens? I can price my product lower than my competitors. I can capture the market. So that is more of a strategic investment. So here, that is the meaning of investment. You have to memorize this. But remember, investment, nothing but is an asset. When do you call something as an asset? Assets are resources that your enterprise controls as a result of a past event. What is the event? You purchasing those investments on a past event, from which a future economic benefits will flow to the enterprise holding that asset. That is the meaning of an asset. You take any accounting standard, they will define five, there are 5 elements of financial statements. What are the 5 elements? Asset, liability, equity, income, and expense. What are them? These are the 5 elements. If you can really understand what are these 5 items, you can never go wrong in accounting. You know that? You just cannot go wrong. It is only lack of understanding whether that is an income expense. Vijay Malaya made that mistake. He thought loan, borrowed as an income, bank to income. No, bank account debit to loan. Why loan credit? You have an obligation to repay. It's a liability, not income. The minute you start thinking your loan is an income, that's what people do, especially people performing all weddings and at least in our part of the world. They borrow money and spend on the wedding because they think that is an income. That is actually what? A liability. And you are investing in some, a project which does not generate any return. No return. It's a no return investment. Are you investing lakhs and lakhs of rupees, right? If you have the money to spend, blow it off, no problem. But don't borrow and blow, okay? Borrow and blow, that blow on your face, okay? So that is investment. And for the purpose of accounting, this standard says that investments can be split into 2 types. What is that? Current and long term. Your accounting depends on that. The accounting for investment depends whether the investments are classified as current or long term. For this, you have to see what is the investors. If you are buying shares in a company, who are you? You are the investor or investor. And what is that other company called? Investee entity. You are the investor and other entity is what? Investee. You are holding shares in Reliance Industries Limited. Who are you? Investor. And what is RIL? It is investee entity. It's an investee in which you are holding investments. And for the purpose of accounting for these investments in your books as an investor, whether you want to classify the investment as current or long term depends on your intent. Intention matters. What is the intention of the management matters? So what is your intention? Now, whether you want to have that as a long term investment or as a short term or current investment. So just a girlfriend or you want to get married in the long run. So that's the best analogy I can think of. Okay. There are people who are childhood friends, they are childhood friends for so many years and get married. That's basically long term investment. Okay. And then current investment, pastime. Okay, that is the current investment. You have no intention to hold it for a longer period. Okay, this is an analogy again. Okay, I know it sucks. Okay, but to get the point across, I gave the example. Remember, the intention matters. So now see what is the definition given for a current investment. What is given?
Para 3.2.
Yes, sir.
A current investment is an investment that is by its nature readily realizable.
By its nature, readily realizable.
And is intended to be.
You saw the word intended. That's a key word. The intention matters. Okay, are readily, that means what? They have a market. You can't say I bought shares in an unlisted company and say what? Oh, it is current investment, unless what? It is readily realizable. See, you are buying shares in a listed entity, it is what? Readily realizable. Anytime you can sell those shares and walk away. So by its nature, readily realizable
and is intended
and both. And it is intended to be held
for not more than 1 year
not more than 1 year from
the date on which such investment is made.
from the date on which you go to buy those investments. You don't hold it for more than what? You have no intention to hold it beyond that 12 months. For two conditions, readily realizable and as an investor, what is the intention? To hold the asset for not more than 12 months.
Then 3.3 long-term investment.
3.3 long-term investment.
Para 3.3. A long-term investment is an investment other than a current investment.
Very simple. They give a negative definition, right?
Yes.
What is not a current investment becomes a long-term investment. And very clearly the standard says we do not deal with investments held as stock and trade. If you are a broker, now holding those investment stock and trade, we don't deal with that. Fine. Alright, that's given in point that is para 3.1 itself. Right? Now please go ahead and take down the three definitions para 3.1, 3.2 and 3.3 in your notebook. Okay, so please go ahead, jot down the definitions and don't tell me it's already there, refer to page number, don't do all that rubbish. Please jot down these three definitions in your notebook. You can pause the recording until you complete. Okay, now we shall get into the accounting for investments. Now that is para 9 of the standard. So how do you measure investments? At the time of making the investment. So what is the amount at which you have to record your investments in your books? That is at time 0, or you say day 1, day 1. So very simple. Suppose you want to buy some shares in the, let's say, through a broker. One you have to pay for the shares, the price you pay for the shares. And then add all the acquisition charges, such as what? Brokerage, or any fees charged by the broker. And also you have to pay something called the stamp duty and any other expenditure you incur on acquisition. But generally it will be brokerage fees or say some duties that are payable or some taxes you have to pay, right, on acquisition. So that is the duty. So that is supposed to be the total amount at which you record or recognize investment in your books. We call para 9 as something what technically you can say it's a measurement on initial recognition. Now when you want to recognize the investment in your books, so at what amount you want to measure those investments? At cost. Cost includes what? Definitely the purchase price you pay for the investment. There's all the acquisition charges, right? So let's go ahead and read what is given para 9. So read.
Para 9. The cost of an investment includes acquisition charges, such as brokerage, fees, and duties.
Okay. So the acquisition cost shall also include, that's a meaning. Definitely you have to include the price you pay for the investment. And also include other acquisition charges such as a brokerage, fees, and any duty. Example, stamp duty payable. All these are includes a part of cost of investment. But I'm going to skip para 10 and para 11 for the time being. That is more of a, we are all known for barter. What is barter? Exchange. Where you can exchange assets. You can purchase a land that is as an investment property, and issue what? Shares in your company, right? So that's a barter, where you want to exchange assets, or you want to exchange, you want to buy some investment, issuing shares or other securities, non-cash consideration, right? So I'll come back to para 10 and para 11 later. But right now, do remember para 9, on initial recognition, you should recognize investment at cost. And the cost includes definitely the price you pay for the investments understood. And also other acquisition charges, such as the brokerage you pay, or any fees you pay to the broker, the middleman, and any duties and other taxes payable on acquisition, right? That is what. This is on at day 1, right? This is on day 1, you should recognize investment at cost. Now, how do you measure investments end of each reporting period? End of year 1, end of year 2, at what amount you have to carry forward your investment in your balance sheet. For example, you take a fixed asset. What do you do? Initially, we measure the fixed asset at cost, the amount you pay for the asset. At the end of each year, what happens? You will record the asset at cost less depreciation. Yes or no? Think about it. Like that, how to carry forward, at what amount you should carry forward your investments in your books, end of each reporting period, on the balance sheet date. The carry forward amount depends on whether investments are being classified as current or long term. You all get it?
Yes, sir.
So the carry forward amount in a balance sheet end of each year depends on whether the investments are being classified as current investments or long-term investments. Now refer to para 14 and 16 talks about current investments. Now what is given para 14, sir? Read.
Carrying amount of investments, current investments.
You know what is carrying amount? The amount at which you have to carry the investments in your balance sheet end of each year.
Para 14. The carrying amount for current investments is the lower of cost and par value.
You saw that end of each year, you should carry forward, means you should record investment in your balance sheet at either at cost or like NRV, right? Inventory. So inventory we say no cost or NRV, whichever is lower. Like that here, cost or fair value. You know what is fair value? Nothing but the market price of those investments. That's a fair market value. Yes, sir.
In respect of investments for which an active market exists,
That means what? Where there is you have bought some shares and those shares are listed. That means there's an active market where there are buyers and sellers.
market value generally provides the best evidence of fair value.
That's all. He says fair value is equal to what?
Market.
The market price of those investments. Simple. So the rule is very simple. You have to carry forward your investments in your balance sheet at either cost or fair value, whichever is lower. But let's see the lower of cost
And fair
and fair. When you start the sentence, lower of, you better write and, lower of cost and fair, lower of two numbers, cost, fair value, whichever is lower. You will start with the sentence this way, cost or fair value, then whichever is lower. But if you write lower of, then write cost and fair value. The lower of two numbers, A, cost, B, fair value, whichever is lower. Suppose the cost is say 100, you bought it for rupees 100 at day 100. Let's say at the end of the year, first year, let us say the market price of these investments are rupees 90. Then what do you do?
90.
What happens at 10 rupee then? You have got an initial investment account, debit the bank account, how much? 100 rupee. That is the entry on day 1. But the year end, what is the investment? Should be only 90, right? How do you bring down the asset by 10? You add a credit investment and in account, P&L. That is what is given in para 16. Now read what is given in para 16, sir.
That is not complete.
14, okay, read 14 further.
The valuation of current investments at lower of cost and fair value provides a prudent method of determining the carrying amount to be stated in the balance sheet.
You saw conservatism, prudence. That is what, suppose 100 rupees investment. Initially you bought, year-end value is 90, even though you haven't sold it, but still there is a 10 rupee what? There is a 10 rupee loss expected. Yes or no? In case you decide to sell these investments in the next year, there is a possibility of a loss. What is prudence? Provide for all losses. Do not anticipate a gain. Okay, next.
Para 16, sir.
For
current investments, any reduction to fair value.
Any reduction to fair value, say cost 100. What is the fair value? Now example 90. Any reduction, 10 rupee reduction to fair value.
And any reversals of such reductions.
Suppose the 90 goes up to once again what? Subsequently next year goes up to 95 or 98 or 99 or 100.
Are included in the profit and loss statement.
What is that? When you want to reduce, what is the entry? Profit and loss account debit 10 rupee to investment 10 rupee. So that what? The investment value comes down. Suppose the next year the value increases what? Then you can reverse. Right? The reversal is permitted.
Investment fluctuation is also.
Reversal also will be through PNL only. That's Sultan clear. Any decline or any decrease or increase, that is any reduction to fair value and reversal thereof will all be included which account? P&L statement. That means take it to profit and loss account. Suppose the 90 rupee investment goes up to once again what? 100 or for some reason the price increases. Then you can take it up to cost, but not above cost. Is that fine?
Yes.
The 90 goes up to 95. Then what? Compare 100 cost or 95 which is lower. So 90 can be taken to 95. What is the entry for 5 rupee increase? Investment account debit 5 to profit and loss 5. Understood?
Yes.
It's as simple as that. Viramaba, any reduction or reversal, any reduction to fair value or reversal will be taken to which account? Profit and loss account. That's what they meant. This is for current investments. What is the rule? You have to carry forward. The carrying amount of current investments will be lower of cost and fair value. And what is the best measure of fair value? The market price. In case investors have an active market, the market price will be the best measure of fair value. And para 16 says how to account for the reduction. The 100 rupee asset is coming down to 90. What is entry? Profit and loss account debit to investment 10 rupees. Understood?
Yes, sir.
You know why they say lower of these two? That's prudence. That's prudence. Be very prudent. Don't anticipate gains. Okay? But provide for all the possible or expected losses. Right? So now we shall go ahead and take on long-term investments. Para 17.
Long-term investments are usually carried at cost.
Are usually carried at cost. Why? Fair value doesn't matter. What is the reason? We have no intention to sell it here. Remember, fair value matters for current investment because at some point you go to sell it. Yes or no? Your intention is not to hold the asset for a long time. Within 12 months, you will be selling it. That is when the fair market value of investment is relevant. Simple rule here. Now tell me, you buy a vehicle. You want to purchase a vehicle. You know what is the first thing you inquire? Is there a The resale value for the vehicle. Yes or no? Have you noticed that? Whenever people purchase a car, they always look for is there a resale value for the car. Why? I don't want to hold it forever. So once a new model comes up, I want to sell this and buy a new car. Yes or no? Nobody holds a car for 15, 20, 30, 40 years. But generally what happens when you purchase a car, at some point you want to what? Sell the car and buy a new model. Lot of people are purchasing car now, they are buying the car only for next 2, 3, 4 years and they want to buy what? Electric vehicles. They're all, we are on the verge. Okay. So that is why you always ask for resale value. If I resell it, how much will I get? The resale value. But suppose you purchase a housewarming ceremony done. Will you go and tell your dad, the fair value is so much, let's sell the property? He's bought the property what to live in that house for the rest of the life. That's it. How does the fair value matter? It doesn't matter. Simple, you buy vegetables at home. Will you calculate NRV for those vegetables? You will not buy. It's meant for. Exactly. Why you come to bullshit? If you're a vegetable vendor, then you want to know the NRV. Why? It's an inventory for you. Then the fair value matters. It's as simple as that. Got it? Now coming back to this Paras 17, are usually carried at cost. We do not bother about the fair market value, or should say fair value.
However, when there is a decline other than temporary.
You saw when there are no exception. It is given that long-term investments are carried at cost. But if there is a decline, they don't say permanent. Other than temporary. That means what? There is a fall in the value of investments. But it is other than temporary. They don't use the word permanent. There is a reason for it. Suppose you buy shares. Let us say I bought shares in the company at rupees 100. How much? 100. Then after I bought the shares, the company had some difficult year due to COVID-19 pandemic. Now they are in deep trouble. Now they are in some financial distress. Now what happened? Now the company is not doing well because they were in the tourism industry. So the share price plunged or plummeted, had come down. Now the shares are trading at 15 rupees. How much? 100 has come down to 50. So this 85, I can say what? It is decline is other than temporary. Maybe there are some financial distress. There is a chance of they going into even liquidation, bankruptcy. That's a possibility, right? So the 85 may not reverse. They don't use the word permanent because sometimes there is a chance of reversal. Why? Suppose this company which you are holding shares, right? That company is bought by another company. And they can buy and what? Reorganize the company. The reconstruction can happen. The price can once again what? Increase. There is a possibility, right? That is why they say, they don't say permanent means what? You should never reverse, right? So they say other than temporary. That means what? Given the situation, this 85 may not reverse. But there is a chance later. We don't know. Right? It's given other than temporary. You don't use the word permanent. Other than temporary. Where there is some financial trouble. They have been incurring losses for the last 2-3 years. And they will not see the light at the end of the tunnel. They might go bankrupt. There is a chance. In that case, you better write down the investments. Write it down to how much? 15 rupees. 85 rupees gone. What is the entry for that? Profit and loss account debit. to investment 85. Suppose 100 rupee comes down to 85 rupees, or 100 comes down to 75 rupees. But normally what happens, the share price normally what? Fluctuates, right? So for such changes, don't reduce the value. Please carry it how much? At 100, don't bother with the 75, 80, 85 rupees. But suppose a decline is so drastic, and the decline is what? Other than temporary, then you have to provide for such reduction. And such reduction will be taken to profit and loss. That's what is given in para 19. Okay. Now read para 17 once again, sir. From the beginning.
Long-term investments are usually carried at cost.
Uh-huh.
However, when there is a decline, other than temporary, the value of a long-term investment, the carrying amount is reduced.
Is reduced to its fair value.
Indicators of the value of an investment are obtained by reference to its market value.
Then.
The investee's assets and results and the expected cash flows from the investment.
How do you know that decline is other than temporary? You will look at what? The investees, assets, then
Results and
the results,
expected cash flows.
and expected
Cash flows of the investment.
from the investment. You know what I was trying to say? Sir, how do you know that Kingfisher Airline is in trouble? But how do you know that company is in trouble? How? By looking at the investees' balance sheet, their assets. Now, what are the assets on the balance sheet of the investee? What is results? What is the result? Their net profit or loss. They report on their P&L. Other result. And also, how much dividends you might get from that company in the years to come. The expected cash flow from your investments. You have to consider all these factors in determining whether the decline is other than temporary. Got it? Hello?
Yes, sir.
Very simple, yeah. The value of your investment is as good as or as bad as what? The financial position and performance of whom? Of the investee. Very simple. Always remember the value of my investment is as good as or as bad as my investee's performance or investee's financial position, assets. You get it? You can't invest your money in a mango and expect apples. You can't invest in a donkey and expect what? To have the donkey to participate in a horse race. Not possible. A donkey is a donkey. Right? So it all depends, the value of an investment purely depends on the financial position, other assets, the financial performance, the profit or loss, or the results, right, on the investee, and also how much capital you expect from your investment in the form of dividends on your shares. Understood? If they are in trouble, what? You will not get any dividends at all, right? They don't even have the money to pay the dividends of holders. How will they pay? How will they pay dividends to you as a shareholder? Got it? Now that's it. Para 17.
No, sir.
Read further.
The type and extent of the investor stake in the investee are also taken into account.
So basically, what is the type of your investment? Whether you're holding equity shares or preference shares or debentures or whatever. Then
Restrictions on distributions by the investee or on disposal by the investor may affect the value attributed to the investment. Restrictions on distributions by
on
the
distributions by the
investee or on disposal by the investor.
You know what is that? Suppose there is some legal restriction. Government says that investing company cannot pay any dividends. Because first they have to clear all their liabilities. Only then they can pay dividends to you. And then number two, the government can say you cannot sell your investments. There is a lock-in. You cannot sell your investments in the market. I think Yes Bank, they said you cannot dispose of the shares. You know that people who thought Yes Bank shares went down. Everybody bought their shares and then what? Bought those shares and they want to sell and make a profit later on when the price increases. They said you cannot sell. But the more number of people are selling the shares, what happens? The share price will start to fall even further. Why? Excess supply. So if there is a restriction on either distributions by the investee or disposal by the investor. Yes, sir.
May affect the value attributed to the investment.
That's all may affect the fair value of the investment. So basically, it talks about what are the other factors you consider before you decide whether the decline is other than temporary. Is that fine?
19.
Agara 90.
Where there is a decline, other than temporary, the carrying amounts of long-term investments, the resultant reduction in the carrying.
The resultant reduction in the carrying amount, say 100 rupee has come down to 15 rupee in my example. Then
The resultant reduction in the carrying amount is charged to the profit and loss statement.
they start debited to profit and loss account. The entry is saying profit and loss account debit to investment. Or you can also say profit and loss account debit to, you can write as provision for depreciation on investment, like provision for diminution in the value of investments.
The reduction in carrying amount is reversed when there is a rise in the value of the investment, or if the reason for the reduction no longer exists.
Once again, you can reverse the reduction in case there is a rise in the value of investments. Or the reason that caused the decline in investment is now reversed. I'll tell you one more reason why investment value can decline. Maybe the government has come with a policy that it's going to affect the investee company. Let's say you're holding shares, okay, in a company which is operating in a particular sector, which is basically a license given by the government. Now the government says that the license is cancelled for the next 2 years. At least for 2 years, what? The price will be low. Yes or no? So you're holding shares in a company whose operations are now restricted by whom? By the government. So the investment value goes down. After 2 years, the government lifts the ban. Then what? Once again, the price will increase. Simple. Got it? So, Pre-Ramaba, para 17 and 19 talks about long-term investment. What do you take home? Very important. Remember, if you have some long-term investments, they are usually carried at cost. Ida para 17 But now it is an exception. However, if there is a decline in what? Read para 17. Decline in the
Other than temporary, the value of long-term.
in the value of investments, and the decline is other than temporary, right? Don't write permanent, other than temporary. Such reduction will be accounted for and will be taken to which account is there in para 19, taken to profit and loss account. But to decide whether it's a temporary decline or not, you have to consider a lot of factors about the investing. What are the factors you consider? The assets, the results of the investee, and also the expected cash flow from the investment. From that investment you're holding, right, in the investing entity. That's why I said investor, investee. If you're holding shares in ABC company, you are the investor, shareholder, and ABC is investee. And this standard talks about accounting in your books, the books of the investor, and not in the books of the company, the investee, right? Got it?
Yes.
Read para 17 once again clean, and then I'll not interrupt you at all. Okay, just read para 17. Then we shall take up an example. Yes, sir.
Para 17. Long-term investments are usually carried at cost. However, when there is a decline other than temporary, the value of a long-term investment, the carrying amount is reduced to recognize the decline. Indicators of the value of an investment are obtained by reference to its market value. The investee's assets and results and the expected cash flows from the investment. The type and extent of the investor's stake in the investee are also taken into account. Restrictions on distributions by the investee or on disposal by the investor may affect the value attributed to the investment.
So based on determining the fair value, consider all these factors. The market price, the assets of the investee, the results of the investee, the expected cash flow from investments, right? And any restriction on distribution by the investee, and any restriction on disposal of our investments, right? All these will affect the fair value of the investment you're holding. Got it? Yes? And that is all para 17. 19 is very clear. Any reduction will be taken to profit and loss statement. And everybody from your textbook, you read para 18. What is the one? Everybody, para 18. Yes.
Long-term investments.
Read it.
We need to read or
No. You read. Everybody, please read with that para. You read. Or,
Long-term investments are usually of individual importance.
I think no, not required. Okay. That's fine. Then okay. Now let me start with this example from your study map. Go to module 1. Go to pause the recording, sir. Okay, now we shall go ahead and take on this example, guys. Take illustration number 3 from module 1. Okay, it is on page 3.132. A very important sum. Now we shall discuss this example. You jot down the solution. Then we'll give a similar sum. You try. Fine. Yes, sir. Read.
Illustration 3. Messrs Innovative Garments Manufacturing Company Limited invested in the shares of another company.
Let's say you represent Innovative Garments, and you have invested in shares of another company.
On 1st October 2023 at a cost of rupees 2,50,000.
You saw you bought some shares in a company on 1st October 2013, 20x3 you bought. You bought shares for rupees 2,50,000 in another entity. Remember, you are the investor and you bought shares in, have you given the name of the company? No. You bought shares in another entity. Okay, for rupees 2,50,000 on 1st October 20x3. Then
It also earlier purchased gold of rupees 4 lakh and silver of rupees 2 lakh.
they say earlier means what? Maybe in 20x2
On 1st March 20x1.
or on 1st March 20x1 you bought gold and silver. For how much?
4 lakh for gold, 2 lakh.
2 lakh silver. Next.
Market value as on 31st March 20x4 of above investments are as follows.
It is given that as on 31st March 20x4, these investments have a market value of, they given the fair value. How much is given for shares?
2,25,000.
Now tell me, will you show this investment in the balance sheet on 31/3/20x4 at 2,50,000 or 2,25,000? You have been holding it for 6 months so far. Will you get 2,50,000 or 2,25,000? No, you should first ask a question. Are these current or long term? Are these current or long term? How current? No, they can be, even gold can be sold. Silver can be sold. No, so what? See, remember here, they didn't say what is the intention of your company, of Innovative Garments. Whether you want to hold it for, right now only 6 months are over, right? You bought these shares on 1st October 20x3, and the year ends on 31/3/20x4. So far, how many months over? 6 months. Right? Now, what is the whether you want to hold it for? Not more than 12 months or more than 12 months. We don't know. Nothing is given the question. You haven't sold it. You are still holding the shares. But are you going to hold it for more than 12 months or less than 12 months? Whether you want to sell this sometime in April, May, June 2014, 20x4, or you want to hold it beyond 1st October 20x4. Depends, right? Nothing given. What do you assume? You can give 2 answers. Suppose these investments are classified as current investments, then we apply para 14. What? Is either cost or fair value, whichever is lower. Therefore, what? You have to bring down the value by 25,000. So the carrying amount will be 2,25,000 in your balance sheet for these shares, and 25,000 decline will be taken to profit and loss account, will be charged to P&L. Understood? Suppose what? These investments are long term, then what? Then you have to ask a question whether this decline is other than temporary. No information given about the investee is in trouble, some financial trouble. What do you assume? It is only a temporary decline. So just a blip. You know, the market normally the prices are driven by demand and supply for the shares. Nothing to do with what? Today you'll find L&T share price falling. Doesn't mean L&T is in trouble. The market participants are driving the price up and down, right? So in that case, you ignore the 25,000 fall and carry forward investment at cost. So that 50,000. You will record the 25,000 decline, only the decline is other than temporary. For that, what they should give some more information about who? Not about you, about the investee. You're holding shares in some company, so let's say ABC Limited. ABC should be in trouble. Then you can say the decline is what? Other than temporary. Got it? There can be two answers to this. What about gold and silver? Definitely long term. Why? You bought it in 2011, 20x1, now it's 201, x4, year end. Definitely long term. Long term what? Always at cost. What is the cost?
Gold
That 4 lakh and 2 lakh, right? Don't bother about the market price. What is the market price given?
6 lakhs and 3 lakhs.
Ignore the market price at cost. Understood?
Yes, sir.
Let's go ahead with the solution. Read.
Question.
Read the question. Okay, complete.
How above investment will be shown in the books of
Will be shown in the books of Innovative
Garments Manufacturing Company Limited.
You are that company. Innovative Garments Manufacturing Garments. Innovative Garments. Okay. I don't know what it is. Anyway.
For the year ending 31st March 2084, as per the provisions of Accounting Standard 13, Accounting for Investment.
Yes, sir.
Solution. As per AS 13 revised, Accounting for Investment.
Always write the accounting standard number and do write accounting for investments. And also use the word revised. Then.
For investment in shares. If the investment is purchased with an intention to hold for short-term period,
You saw that intention matters, right? For short-term period.
which is less than 1 year, then it will be classified as current investment
Investments.
and to be carried at lower of cost and fair value.
Cost and the fair value.
That is, in case of shares at lower of cost, rupees 2,50,000
And fair value rupees 2,25,000.
as on 31st March 2084, that is rupees 2,25,000.
That's all. That will be the carrying amount 2,25,000. Next.
If equity shares are acquired with an intention to hold for long-term period,
Or long term, they have more than 12 months. Then
should be considered as long-term investment to be shown at cost in the balance sheet of the company. However, provision for diminution,
nothing but provision for decline. Okay, provision for diminution, nothing but decline.
should be made to recognize the
Recognize a decline other than
if other than temporary the value of investment.
exactly. If that 25,000 fall is other than temporary, then record that 25. Otherwise, don't. Then
Gold and silver are generally purchased with an intention to hold it for long-term period,
hold it for long term period.
more than 1 year, until and unless given otherwise. Hence, the investment in gold and silver purchased on first March
Basically, until and unless given otherwise, normally we assume gold and silver about for what? Long term. Okay.
Hence, the investment in gold and silver purchased on first March 2081 should continue to be shown as cost.
Shown at cost, which is 4 lakh rupees and 2 lakh rupees.
Since there is no other than temporary diminution as on 31st March 2084, that is rupees 4 lakh and 2 lakh respectively, though their market values have been increased.
Have increased, don't record the increase. Even if it's a fall, don't record the fall unless what the fall is other than temporary. That's it.
That's all.
Please go ahead and jot down the solution. This is the way you write the answer. For shares, both. Okay. It depends on whether it's a current or a long-term interest. And gold and silver are usually long-term. They are carried at cost. You can pause the recording till you jot down the solution. Okay, guys. Okay, so you guys are done with the solution.
Yes, sir.
So remember, it all depends on the intention. In case of the first asset shares in a company, 2,50,000. Whether it's 2,25,000, 2,50,000 depends on your intention. Whether you're going to hold these shares for more than 1 year or less than 1 year. What about gold and silver? Are generally held for a long term, right? For a longer term. So in that case, you just have to value those investments at cost and just ignore the market value of those assets, of those investments. Fine. Got it? And this can come for 5 marks. So next time we'll do a similar sum. Okay. So we are done for the day. Bye-bye.